Welcome back to our weekly market update. My name is Shahid.
And my name is Fairuzee. So we are back here to update you on what is happening in the market and the stock market. Yeah, so Shahid, we start off with our usual update on the index, S&P 500. Yeah.
Okay, so for the S&P 500, it will be different if we make the update like yesterday.
Yes.
But for today, the update is different.
Yeah.
Because if we look at the chart now, it has gone down.
Yes, it's gone down.
Okay, from all-time high yesterday. So yesterday it was 7,600. Now it's only 7,553. If I'm not wrong, yeah. So it gone down quite a lot.
Yes.
So Fairuzee,
Yeah.
this is the start of the down market?
I think it might have what we call here an effect in terms of it going down. Okay, there will be a fall in the market. But will it be permanent? That's what we are going to discuss today.
Yeah.
But the most important, I want to ask Shahid, is there any headline in these few days that makes the market go down?
Yeah, so the recent news that we heard from the market, from the headlines, is that there's been an attack between Iran and US.
Yes.
To be more specific, there's an attack in Kuwait.
Yes.
Done by
Airport.
Kuwait airport.
Done by Iran, right? By Iran drones.
Yeah.
So this is the part where people are having that 50-50 on the peace deal between US and Iran.
Yes.
Yeah. So, but having said that, it is still, the peace talk is still running and proceeding.
Yes.
And this is what people maybe are confused. They are saying that you have a peace deal, but they are still attacked. And I think Iran did that because US also did a strike.
Yeah.
Before that.
Yeah.
So that is why oil price went up.
Yeah.
Yes. Oil price went up because of this uncertainty. And because of this uncertainty, oil price went up, and hence the market went down. Because if oil price goes up, means that the inflation may go up, may rise. Because take note here that the market is indicative of what will happen in the future. So if oil price keep going up, then the market will not be good. But then again, this is headlines. It can change anytime.
That's right.
So if it change, example, tomorrow oil price goes down, then the market will go up back.
So time and time again, we have always shared and said that we can't rely 100% on headlines.
Yes. Headline moves the market, but not permanently.
So what we should really look into is the fundamentals.
Yes.
So now we are going into the fundamentals.
Yes.
So what should we understand now? Look at the market.
Before we look into the fundamental, we have to understand one thing, which is bonds. So today, we would like to share what is bonds. So we are going to talk specifically on US Treasury bills, US bonds. Okay, so there is a fundamental point here in this US bond or US Treasury bills. So what is a bond? A bond is basically the government is borrowing our money, our hard-earned money, so that they can actually
do their
project. The project includes, supermarkets, schools, colleges, universities.
Then what is it for us if we lend our money to them?
So if we lend our money to them, then they will give us a guaranteed yield. Return lah basically. A guaranteed return. So the guaranteed return, is example 5%. 4%. And take note here that your money is locked. So you can have 1 year, 2 year, 5 years, 10 years, 30 years, right? So currently the 30 years yield is 5%. So if you invest or if you put in 100k, then the 100k will be locked, and you will get 5% every year.
So what's attractive about these treasury bills is that first and foremost, your capital is guaranteed.
Yes.
Right? and secondly, the return is guaranteed at 5%.
Yeah, 5%. I mean, depending on the yield lah. So right now, the yield is going up. Okay, the yield is going up. So this became or will become a concern for us investors, especially us investing in US stocks, technology companies. Okay, and of course it has an effect on the global stock market too. Okay, so why this a high yield and a problem? Okay, reason being is because if the yield is high, right? So the previous bonds, the price will be lower. So for example, the yield last year or last few years, a 30-year yield, 30-year treasury bill yield is maybe 3%. So I am holding that for 30 years, but I see, oh, now US is giving me 5%. So what I do, I sell off lah. If I am selling off my bonds or my treasury bills, people will not buy it at that price. They will not buy, okay, example, I buy it at $10,000. Okay, they will not buy it at $10,000 because, Fairuzee, why you want to sell me this and I get 4% while I can actually buy new ones with a new yield, with a new return that is guaranteed. With 6%, 7%, 8%. Why should I buy yours at 4%, 3%? And I have to hold on to that. So what happens is, okay lah, I sell you cheaper lah, Shahid. You buy 8,000 lah. The yield will still be 4%, okay? But you buy cheaper lah. So mathematically, the return will be a bit higher lah than 4%. Okay, so that's the story of bond and the yield. Okay, so basically, if yield goes up, okay, the new bonds or the new treasury bills yield goes up, the price of bonds, old bonds, will go down. Why? Because people will sell off this lah. If the yield goes down, example, in the future, maybe next year, the yield will be 3%, 2%, low, right? Then the old bonds will go up.
Understand.
Because why? People will not sell. People will not sell anymore. They will hold on to it. So if people wants to buy, then they will have to buy it at a higher price. So now, Shahid, why is it a problem for the high yield then?
So when the yield is high, okay, so bank must make a move. Okay, so they want customer also, right? So to attract customer, they will give a higher interest rate for their fixed deposit.
Correct.
Okay, but what happened when they did that? It will affect the one who's borrowing money from them. Okay, so let's say for example they are paying their debt $500 per month around. Suddenly it become $550. Or maybe $570.
So basically the consumer, us lah, citizens, we have to pay more lah for the debt first, and companies also will pay more. So price will go up lah. So inflation. Basically inflation. So higher the yield, inflation might be there. Then how about the stock market?
Okay, as for the stock market, it will slowly maybe go down, gradually go down. Why?
Like what we are seeing here.
Like what we are currently seeing now. Why? Because investors are attracted to the yield that they can receive.
Because it's guaranteed. In their mind, it's guaranteed 5%. So why not, right?
To them, 5% is good enough because it's guaranteed. My capital is safe. So that's why they will sell their stock holdings and they will put their money into the treasury bills. And that's 2 points that I can share. I think there are another points that we can share.
And I think this one is not really a bad consequence, but the US dollar will be stronger lah. Because why? People, if they want to buy the US treasury bills, they have to convert. I mean the countries lah, Singapore, Malaysia, because it's also an opportunity for them too. Okay, because and also take note here because governments and countries their risk threshold is lower. So 5% for for these treasury bills is actually quite attractive. So but they have to convert their money Singapore dollar to US though. That's where US dollar will be stronger lah. And lastly, and this is the most worrying for me lah, the debt, US debt will grow more because if they keep on offering high yield, high returns, they have to pay back these years. So if they cannot pay, then there's a problem. But that's another story for another day lah. But then the debt for US will be a lot more lah. And they need to offer higher yield because they want to attract investors lah. To buy in their what we call here their treasury bills lah. So I think this is why one of the fundamental things why market went down. So we have to brace ourselves lah, and we have to have strategy lah. And I think our strategy also includes this situation where the market will go down. Our strategy, we are prepared for it. So it has been happy moments. For the past few episodes, I think quite a lot lah.
For the past few weeks, almost a month.
It's happy episode.
But I think early of this week we had a discussion, right?
Yes.
I think the market is going. We think the market has been going up for quite a while.
Then
soon enough they will start to fall down.
And it's a good opportunity. For everyone. So hopefully those of you who are listening to this, brace yourself in the sense that prepare your cash, start to invest lah. The market will go down. But for those who are investing with us, don't worry, our strategy has covered this situation, and we might be investing more lah, or we might be changing or do some switches to accommodate to this situation. So I think that's all for today. Hopefully we are prepared for whatever is to come next week or next few weeks. Right? Okay, so I think that's all. See you next week. Bye-bye.
Bye-bye.